Oil fell. Wall Street stamped relief before the ink dried. In Monday's pre-market snapshot, Brent crude was down 8.8% near $88.30 after the United States and Iran paused hostilities, while Nasdaq 100 futures rose 1.68%. That reaction is real, but it is not the same as proof that the pressure on technology stocks has disappeared. Lower oil matters because energy is not just another ticker. It feeds into inflation expectations, the expected path of Federal Reserve policy, Treasury yields, the dollar, and eventually the discount rate investors apply to long-duration assets. When that chain loosens, AI stocks and other growth names can breathe. But breathing room is not a clean bill of health. The market had spent much of July worrying that higher energy costs could keep inflation sticky and force the Fed to stay tighter or even tighten again. Monday's oil reversal eased that fear, and Reuters reported lower yields, a softer dollar, and stronger equity futures alongside the move. The Fed has not entered the room, but oil already moved the furniture. The actual policy decision is still due Wednesday, and the market still has to hear how policymakers describe inflation and the risk of future tightening. There is also a physical market limitation. Reuters reported that shipping through the Strait of Hormuz and the Red Sea remained constrained, while the Energy Information Administration's outlook shows how strongly future supply depends on traffic normalizing and shut-in production returning. Today's decline is therefore a reassessment of risk, not a guarantee that energy costs will keep falling. A renewed disruption could reprice the entire inflation chain quickly. Tech also faces its own test. Microsoft, Meta, Amazon, and Apple are reporting into a market already questioning whether enormous AI spending will produce returns fast enough to justify current expectations. A lower oil price can improve the macro backdrop, but it cannot repair weak guidance, narrow breadth, or disappointing cash flow. Macro relief and earnings proof are different documents. So what would turn relief into confirmation? First, oil must hold most of the decline instead of snapping back on renewed supply risk. Second, Treasury yields and the dollar must remain contained, while the Nasdaq rally survives the cash open and broadens beyond a handful of mega-cap names. Participation from semiconductors and Bitcoin would strengthen the signal, because real risk appetite rarely stays confined to one convenient corner. The relief stamp is still provisional. If oil rebounds, yields rise, the dollar strengthens, or tech breadth fades, the market is telling you that the headline changed faster than the liquidity regime. If those signals stay calm through the Fed meeting and major tech earnings, the rally has a stronger foundation. Oil can remove pressure. Only the bond market can confirm liquidity.